Hello, everyone, and welcome to the Kruze Consulting Venture Capital Pitch Deck course. This is our free course that helps you figure out how to put together a compelling venture capital pitch deck. In this piece here, we're going to actually be walking through not a spreadsheet, but instead an Excel model, talking through your financial model and giving you some tips and tricks to help make the financial model tell the same story that your pitch is. As usual, I'm joined by Haya Camps, the TechCrunch author, startup founder, and also a former venture capitalist who is a pitch deck consultant. Hi, how are you?
I'm doing great. How are you?
I am great. Hey, where can people find you online if they want to get your help?
Haya.me. I'm super easy to find. I even wrote a book about this stuff, which is super handy. So you can find that on haya.me/book. It's a whole book about how to put together a pitch, which seems relevant to what we're talking about.
Extremely relevant. Excellent.
You know what's missing from that book, though? It's my least favorite thing about any of this, which is what we're talking about today.
Financial model. Well,
yep.
Thankfully, I guess I'm here, right?
Yep.
And just so everyone understands background from my perspective, I run FP&A, financial planning and analysis, for Kruze Consulting. Kruze is, I believe, the largest CPA that's 100% focused on VC-backed startups. Our clients raise well over $1 billion a year. And my team helps our clients put together their financial models for their fundraisers or to manage their money. So this is what I do, and I'm pretty passionate about it.
And funny enough, that's actually how we met too. I've run a number of companies in the past, and I've actually used Kruze for most of them as my financial partners. And it's wonderful to be able to work with people who go deep under the skin of these types of things that make my eyes completely glaze over. I'm a really solid operator, but spreadsheets, especially financial spreadsheets, I'm like, kill me now.
Yeah, we like numbers, so you don't have to. That being said, if you're running a business or you're raising money, you got to at least be able to talk a little bit of the talk, because finance and accounting is the language of business. Yep. And at some point, that's the language that the investors are going to want to talk to you about. So let's discuss how to do it here. My quick background as a VC, was an exec at a handful of startups, one of which went public, one which grew and we sold. Some didn't do that great. My clients here at Kruze have raised hundreds of millions, if not $billions worth of venture funding since I've been working with Kruze. And so I've got a pretty solid handle on what VCs are looking for when they're looking through a financial model.
Yep.
So why don't we just kind of dive in, and I'll talk a little bit about, what the overall goal of the model is.
Yeah. I think there's some interesting context here, right? So as part of the first pitch you do, you typically talk through an operating plan, which is, we have a separate episode about that, which is all about the kind of the future you can see. Like, that's probably going to be the amount of time that you're going to operate through on this round of funding. So if you expect to raise about 18 months worth of funding, your operating plan will be about 18 months. In addition to that, there's going to be a financial model, which is probably going to be 3 to 5 years, and maybe even beyond that. And once you get through the first, once you get put through the ringer for the first time, you'll be invited back. And the question will be something along the lines of, hey, talk me through the financials of your business. That is where this becomes super, super important. And even if you're somebody like me who kind of goes, I don't know about this, you have to really deeply understand what the financial levers are. Like, if you change something, what else changes? If you hire earlier, what does that do? If you hire later, if you grow faster, etc. And financial models are such a beautiful way of outlining that. And I'm really excited to have you talk through the one we put together for one of our mock companies.
Yeah, perfect. And so just to kind of deep dive into there, as you're doing due diligence and getting closer and closer with the VCs, they're going to want to look at your model, and they're going to want to have a conversation about your model and your historicals. This really shouldn't be the thing that makes it so you don't get an investment. This should be just sort of a slight check the box, advance the conversation, help the investors understand how you're strategic and what KPIs you care about, hear from them what KPIs they care about, what numbers they care about, right? This should be just a beautiful meeting of the minds, advancing the ball on selling the equity of the company, advancing the ball on the story. This should not be the reason you don't get an investment. This would be really tragic if your numbers and your projections were the reason you didn't get an investment.
Yeah, absolutely.
Okay, perfect. So Hi. So why don't you talk a little bit about the company that we're going to discuss here? And again, you can go to kruzeconsulting.com/pitch-deck to not only see all of our talks about the pages, but also see the example company that we created out of thin air, including the slide deck. So you can follow along a little bit better about what we're talking about here with the model.
Yeah, so this is the hilariously named 4P. company, which is a plumbing company that we made up. It's a B2B SaaS company where we are a company that provides a SaaS solution for plumbers and for plumbing services to help them essentially run their businesses. And so behind that, we did a bunch of work. We put together some mock financial models. We put together some mechanics and a full pitch deck. So as you just mentioned, the pitch deck is available on the website. And today what we're talking about is the kind of this, the spreadsheets and the I guess the financial mechanics that are behind this made up company. Now, I keep saying made up because when we started going through this model in more detail, we realized there's a couple of like little loopholes in there, or little wobbles, and we'll talk about them too. But I think it's a really helpful exercise to be able to talk about real numbers, even for a made up company.
Exactly. Wonderful. And just to set the context here, I'll present some of the slides from the 4P pitch deck, just so you can see where the financial flows to, because this helps you understand how this is advancing the ball in terms of you selling the company and telling stories, right?
Yep.
Okay, so hopefully you can see my screen. So first of all, in the 4Ps presentation, the financial model drives this chart behind the traction and milestone, and also the metrics, right? It's a pretty important part of the pitch. We have the operating plan, which Haya has mentioned.
Can we pause for a second and go back to that one?
Oh, of course.
So the reason that slide is so important is that it explains to the venture capitalist why this is a venture backable company. I know we've said this in the other episodes, but that up and to the right graph with the ARR, so the annual recurring revenue improving, the user growth being aggressive, and being able to reduce the blended customer acquisition cost. Those are metrics that look really, really good and help explain. This is the slide you put in front of someone to make them lean in. Now, what happens next is to go, okay, I want to see where these numbers came from. How did this happen? What are you projecting? What are you assuming? What are your assumptions? All that kind of stuff. And that's where these other slides become really, really important.
Excellent. Excellent. So this is the traction slide. This is the operating plan slide, which we talked about before. The goal here is to show the investor what you're going to do with the money that you have and what you look like when you're raising out of money, so they have confidence that you're building a valuable company that will be able to raise its next rounds of funding.
Yeah. So I like to think of this as like the 10,000 foot view. This is like the numbers are all rounded. It's really simple to talk about, and it's really easy to pull out the top level numbers, right? It's very clear what's important here. It's the ARR and the team size. Team size because it represents the cost, and the ARR represents like the biggest number that we can come up with to really show the health of the business. And the other numbers on this sheet are important, but they kind of support those two numbers and explaining all that kind of stuff. And so we go a little bit deeper in the next one, which is our financial model. That's this one. And what we're showing here is actually kind of the same stuff, except broken out to an annual level. So year 1, 2, 3, 4, 5, and going into a little bit more detail. Now, the spreadsheet we're about to talk to informs all three of these slides. I'd love to take a look at that.
Great. Awesome. Let's jump over to it. Here we go. In fact, you can literally see these were the same numbers on the operating slide are
They're
coming
so
out of
similar
here.
because they copied and pasted them across.
Exactly. Here is the summary, although I just noticed we changed the amount of cash being used here. I'll have to go check that out. But anyway, oh, I see what happened. I actually got to probably put that back in. We've got some beautiful graphs that sometimes make sense. We have this is the chart that was in the traction slide. This is one of your up and to the right charts that will really help you out. And then here are this is the guts of the model, which we'll talk through at a high level. The purpose of this isn't really to talk about how to do things in Excel. It's how to talk about things in Excel, right?
Yep.
So that's what the purpose of our conversation is. So I'm going to stop sharing just for a second, and I'm going to talk to you a little bit about like what is the purpose of this model, right? Like I'm a venture capitalist. You're the founder. You're pitching me. I'm going to look at your model. What's happening here? Like, so I am checking to make sure that your vision that you've told me, maybe over coffee and then through a more formal pitch process, like pitch deck meeting, I'm checking to make sure all of that is the same in this model. The model should be telling the story that you've been telling. It should be telling your strategy. You should be selling yourself and the company and how awesome you are in the market, et cetera. This is a piece of sales collateral, and it's all designed to tie very tightly with the pitch.
Yeah, totally. And I like to liken this with kind of the Matrix, right? When you see when you see Dozer sitting in his chair going brunette, redhead, that's kind of the thing, right? The beautiful shiny slides we showed is the glossy layer on the front of this. Now we're going to go under the hood and get kind of gritty and dirty with what's actually happening underneath. It is so important to be able to talk through it, because here is where you're taking your story and turning it into numbers. It's actually the same thing. There should be no discrepancies there. And when you just pointed out, Healy, that, oh, wait a minute, I changed that, that is a warning sign to yourself, right? Put on a Post-it, stick on your screen, make sure you update that before you pitch, because those two stories should be the same. And, so when you're hiring people, make sure the hires show up, make sure that everything kind of goes all the way through. And really, this is the magic that drives everything else.
Exactly. So I did just go update that number because it is germane to the next thing that I want to talk about here. So
We're running live.
Exactly. This is real life here. Hopefully you don't do this in your pitch deck meeting, but you know what? VCs are somewhat understanding if you're humble. So
yep.
Hopefully you can see my screen again. I've gone to the summary tab, which again matches the summary in the pitch deck. So what I'm a VC, like, what am I looking for here, right? Well, the first thing I'm going to go do is I'm going to check to make sure that your startup is big enough to be acceptable for a venture capital style return if you hit your numbers, right? So I'm checking to make sure you're dreaming big, and I'm seeing $50+ million in ARR out in year 5. So that's good. That means, hey, you are playing in the type of venture capital size business and market, or at least you think you are. That makes me feel really good.
So Healy, we're looking at a couple of things here that are interesting, right? So what I'm seeing immediately is that in year 5, we have a $56 million ARR. That's a hell of a business, and that's going to get interesting. I also see that we are running at a pretty significant loss still, like a negative operating margin, even at year 5, even when we're turning over 50 million. So this is a very cash expenditure heavy business. And as an investor, what I think I'm looking for here is, clearly the business is big enough. 50 million ARR is a very healthy business, but we're also burning through a lot of cash. And I would be wondering, like, how quickly do we run out of cash, and how much cash do we have to raise? Does this model show that?
So it does. It definitely does. And that's the second thing that I think most VCs are going to look for is, how much money do you need right now? Where's the money going, and when do you run out, and what do you look like, right? So in the near-term operating plan, we do have a cash balance number that is pretty important. And you can see it's tipped up here to 20 million because the company is raising 20 million at that time at a Series B. But you can even dive more deeply into the projections, because it has a mini cash flow statement that shows the cash balance, right? So as a VC, I would try to figure out where your cash total is, which might be on a balance sheet, or it might just be in a little cash flow statement. It might just be it's like a simple total that you have for an early stage company. You don't have to be too complicated. That's what I'm looking. So I'm watching your cash go down, and I'm seeing, okay, you're basically running out of cash around the middle of 2023.
Right.
And so that I'm trying to see, like, when do you run out, right? So,
yep.
And then, conversely, like, what do you look like? And so, the next thing I would do as an investor, if I was familiar with this particular model template, is I would scroll up and just check out your ARR as you're running out of money, right? So your ARR is here. And I would say to myself, can a company with this trajectory and, approaching kind of 3 growing quickly to 4 million in ARR raise a Series B? In today's market, you can. So I wouldn't be too concerned about that. Now, I have seen markets in the past where this wasn't enough. I mean, I used to advise startups that they needed $10 million in ARR for Series B, but that's not really the case anymore.
Yep.
But this is a place where you, as the founder, should be leaning into your current investors who hopefully know the market, and you should be talking to founders of companies that are in a similar business model to yours that are a little further along, non-competitive companies, where you can develop a relationship with the founders, and you can say, hey, you just raised a Series B, what do you need to look like? I'm thinking I'm going to have around 3 or 4 million in ARR, growing pretty fast. Do you think that I can raise a Series B? Right? Like, ask those questions, have a network so you can understand if you're proposing something wildly off market.
Yeah. And there's a bunch of other stuff that shows up here too. Like, as we talked about in the operating plan, we're talking about milestones, right? So part of it is the number, part of it is milestones. Do you get your product out in time? Do you have, when you run out of cash and you don't hit major milestones along the way, that it's going to be really hard to raise money. Because what they want to see is that they gave you however much money we're raising here, $6 million, $5 million.
5.
9? Where is the funding raised?
9, I think.
Yeah. Okay. So we raised $9 million. And with that $9 million, we have to hit certain ARR numbers. We have to hit certain milestones. And from that, if you put that in front of an investor and say, hey, if we manage to operate against this plan, if we manage to spend those 5 million, we get to these numbers, we have these product milestones, we have this team in place, can we go and raise that 20 million? And if the answer is, we don't think so, then this is not a good plan. If it is, if they say, well, actually, yeah, everything I know about this market and about you and about your team and everything means that it should be pretty straightforward to raise $20 million in year 2, then, you know, we're talking about some really cool stuff here. And we're talking about a plan that if you manage to execute on it, you're going to be okay. And really, I think that is one of the big, correct me if I'm wrong, but I think that's one of the big things that the VCs are looking for here.
So that's for sure. Yes, 100%. In fact, if you ask experienced VCs, you know, what are some of the signs that your company is, or your investment that you've just made is going to be successful? It's that they're hitting their numbers, they're hitting their hiring plan, they're launching their product on time. Like, achieving your plan is a strong indicator that your company is going to be a great outcome for the investor, right?
Yeah. So
so this is your marching orders, right? This is how you're telling the VC you want to execute. And it now kind of going to the next thing, which so we just talked about, you know, VCs checking to make sure you're going to get really big. They're trying to understand how much capital you're going to use and what you look like as you're running out of money. The next part is the VC is evaluating your experience level and competence as an operator, which there are many places in this model where there are assumptions, right? And so the VC will want to look at those and say, does this seem right or not? And a great place to talk about those with the investor is in the operating plan, because we have higher level metrics on here, right? We have customer count, right? And we have customer LTV, we have LTV to CAC. These are all metrics that are springing off points for you having a conversation with the investor about what you're going to look like over the near term, to get them comfortable with your ability to operate the business, to get them comfortable with the idea that you understand the important KPIs and that you're a good business executive.
Yeah. And even here, we're seeing a couple of really interesting things, right? In December 22, there's a 3.5x multiple, but even just 2 quarters earlier, it's a 7x multiple. And as a VC, I'd be looking at, wait a minute, that's a pretty, you're halving your LTV to CAC ratio. What does that mean? Right. And it's not a big deal. You just have to be prepared to talk through it, because there will be questions there. So absolutely guaranteed.
Yeah. So the VCs are generally pretty good at noticing kinks in the numbers, right? So one I would point out would be in this user ARR, which we also have in the pitch deck, you can see that there's a period of time, right? Basically a 1-month period here where the user growth doesn't really grow and the ARR doesn't grow, right? And what that indicates for a company that's still attracting customers is that you had churn. So there's probably a story here, and you look very credible to the VC if they point that out and they say, what happened here? And you say, we had outages, or we had a couple of large customers come on and they expected certain features that we didn't have built yet, right? Have a specific reason. And another underlying piece of advice that I give to founders who don't have a lot of customers or have had very minimal churn is know the name of each client that has churned and know why they churned. That's really powerful. If you've lost 5 companies over the life, or 5 clients over the life of your company, and you can explain why each one left you very quickly, that shows the investor that you are super focused on client success and super focused on understanding what makes your product successful in client size. That is a huge win. And I strongly recommend that founders who haven't had a lot of churn yet follow that advice and really understand and have memorized specifically why each client is left.
Yeah. And again, this is all, so part of it is understanding, and that feels really operational, but a part of this is storytelling, right? You're going to get challenged. You're going to have, you're going to make mistakes along the way. You're going to, your model is dead. I can promise you one thing about it, which is it's not a crystal ball. You're not going to be guaranteed that this is exactly what is going to happen. But the other thing that this model shows is that you've thought about eventualities, right? If you aren't growing as fast as you thought you were, you can hire slower. If you're growing much faster, or if you need to grow much faster, you can spend more marketing dollars or whatever it is, right? There's lots of levers you can pull here. And understanding the model deeply means that if you get challenged on something, you can say, well, actually, we've thought about this and we looked at what would happen if we double our marketing spend, or if we double our hiring cadence. That means that the time before we need to raise money gets much shorter because we spend much more money. But actually, there's an interesting, this is the hockey stick curve people talk about. You spend very rapidly and money burns out really, really quickly. But what that buys you, in theory, is the ability to grow much faster with a little bit of a lag. Running a startup is much like flying a hot air balloon, right? If you pull the handle, it takes a while before the balloon starts going up. And so this is the thing. If you decide to hire 20 people tomorrow, you're not going to have a pipeline that enables you to do that. So deciding to hire today means you're probably going to be hiring over the next 3 or 4 or 5, 6 months to get the right people in the right chairs with the right skill sets and get them trained up and get them effective. Even if you have the perfect developer, if they join tomorrow, they're not going to be deploying code for a little while. So knowing that things take time and there's no shame in that. The VCs know that too, but it means that you have to be a little bit clairvoyant about what is about to happen in order to be able to pull the right levers and make the right decisions. And that is absolutely something you're going to be judged for as a startup founder. If you're completely oblivious, if you say, oh, we raise money on Tuesday and on Thursday we bring on 35 new people, it's not going to happen. Like no matter what, it's not going to happen.
That's right. And so you're trying to prove to the investor that you're a credible executive, you have experience, and you understand that magic things generally don't happen in businesses, right? So that is definitely one of the major mistakes I see founders make. And we'll list out some of the biggest issues I see regularly with models that founders are producing. But just to be super clear, immediately after you raise money, you don't magically hire a bunch of people. Now, it is possible that you have folks waiting in the wings who are like, I'm going to quit my job at Facebook or Google as soon as you can pay me a salary. That's fair. Like that's totally fair. But to not have a big hiring funnel already built and people have it ready to give notice, like you're not going to just have people start the next day. And even when they're ready to start the next day, what that means is they generally need to give 2 weeks notice. Most people want to take a month off or a couple of days off to organize their life after they leave their former job. So just to be thoughtful. You are being judged. You are being judged. So
totally. And the ugliest version of that I saw was like, oh, we're going to raise $20 million. We're going to spend 5 of that to acqui-hire this entire company that does exactly what we need. And I was like, okay, buying a company is not going to take you 3 weeks. And then once you buy them, some of the stuff are going to leave, right? There's no amount of golden handcuffs that makes people stay if they don't want to. The people who are kind of already 1 foot out the door, they might stick around or they might take this as an opportunity to leave. And again, spooling people up takes a while. Learning the code base, learning how things are done, like really kind of grokking the learnings from previous things that the companies have tried. Yeah, don't misunderestimate that, as they famously say.
Exactly. Okay, great. So before we do a little bit more of a detailed walk through this piece of Excel, let's discuss the level of detail that I think is appropriate for a fundraising model. Mm-hmm. And cutting to the chase, I would suggest, particularly for a seed and Series A company, you don't go too detailed. Okay, because detail, when you get in the weeds, at least some of the investors who are doing diligence are going to get down in the weeds, and they might even try to dig one level deeper. And then you end up talking about things that aren't strategic, or you maybe end up talking about Excel formulas, when what you should really be talking about is your strategy and how that impacts your numbers and your metrics. Okay, so you don't need to be incredibly detailed in a financial model, particularly for a seed and Series A. For a more sophisticated company raising a B, you may have a part-time CFO or a finance person who can help you be more sophisticated. The level of complexity will go up, and in particular, later stage investors have teams of analysts who can dig in. But a seed and Series A investor, you shouldn't need an excruciating level of detail to explain to them your financial projections.
Yeah, totally. And I think the other piece that people end up looking at is remember that, like, once you're working with your venture capitalist at a more deeper level, they're probably going to have a board seat, which means they talk to you on a regular basis, but they really go deep. Go deep. They get a 60,000 foot view every 2 to 3 months, something like that, right? And so it is kind of absurd to start talking about what is your snacks budget, how much are you going to spend buying computers for your staff members, right? That's not something that the board should ever really get involved in unless you are spectacularly mismanaging your company. And so really what the level of trust you need to build with your investors is they need to trust you to do the right thing between board meetings, and that they can have big picture strategic input in the direction and the decision-making processes of the company. And so that's the reason why somebody might get a little bit more granular, just to kind of kick the tires and just to get an understanding of you as an operator. Like, can they trust you in the 3-month span between each board meeting? And really, with a good model, what you're saying is, yes, you can trust me. I've got this. And then you can really get into the big, interesting strategic conversations, like which market do you go after? How fast do you hire? What is the big picture product strategy, that kind of stuff.
Exactly. Perfect. Great. All right. Well, now let me do a quick walkthrough. This may be similar to how you walk through the model with an investor. And again, the idea is to present the strategy. So you quickly want to get through the architecture, or like the sort of design of the model, and you want to start to get into explaining what the company is trying to achieve. Okay.
Right.
So I will share my screen again. Okay.
And so just to kind of to translate that for humans who don't speak spreadsheets.
That was pretty clear, but okay, go for it.
I mean, I'm asking for a translation. So what I heard you say is that what you're about to talk me through is where the different parts of the model come from and how they feed into kind of the master sheet. Is that right?
So actually, what I'm going to talk through very quickly is I'm just going to lay out the land for the investor so that they understand what the different tabs do. And I'm not even getting particular. I guess I'm sort of how they talk to each other, but that's not like kind of the super goal, right? And so
awesome. Love it.
If you're present now, so we do have an instructions page, which you probably don't even need to mention to the investor. Okay, I probably wouldn't even mention that. But if I were to do the walkthrough, I would say we have the model tab where all the assumptions and calculations occur. It's monthly. It flows to an operating plan, which shows what's happening for the next 18 to 24 months. We have a summary tab that's a 5-year view that shows what we expect to be like in 5 years from now, and shows you how much money we're raising to get there, how many customers, et cetera. We have some graphs, in particular showing our cash burn and cash position, and we have our ARR, or near-term ARR, or historical ARR, and user growth terms. So just pausing for a second. So what we've basically done is you've explained to the VC what the different tabs are, so that they can, in their mind, orient if they have a question where they might go to check it out. Okay.
Perfect.
Great. Now, in terms of the depth of this model, I think you are wasting your time if you actually go and explain to them how all the formulas work. If you strongly feel like that's something you need to do, here's a pro tip. Record a quick video of you walking through the formulas and share it with the venture capitalist a couple of days before you actually meet with them to talk about the model, so that they can spend the 5 minutes looking through that. So you don't have to waste the 5 minutes of the precious time you have with them explaining Excel formulas. That is a huge waste of time. Okay. So again, if you have a nice little model, record a quick video, jet it over to them when you send them the Excel file and say, listen, here's a quick video that talks about how the model actually flows.
When you say explain the Excel models, does that mean like literally explain what the different formulas do, or how the data flows through the sheet?
Sometimes, generally, how the data flows through the sheet. Most VCs should be able to handle the formulas. And if
that was what I was curious
about.
And
if they can't, you know what, that's fine. Not every investor wants to spend a lot of time in Excel, so it's not that big of a deal. Don't judge them harshly, is what I'm trying to say.
Totally.
Okay.
You're talking about some pretty cool and esoteric things here. You've got some cost of goods sold numbers there. You've got some revenue numbers. And if you scroll down a little bit, when I was looking at this, I noticed something really cool around the headcount and how those numbers.
Exactly.
Is that the kind of stuff you would talk through?
Well, so I would, in a video, I would say, listen, this is how the model works. I would say we input the number of customers that we're going to have in any period here. This is the kind of end of period number of customers. Now, quick timeout. This model is probably fine for a seed or Series A SaaS company. When we build models for our clients, we get a little more complicated, where we have beginning customers, new customers, churn customers. There's a deeper level of detail possible that I didn't think was worth anybody's time for this particular pitch deck course, but that is something you could do. Okay. Yep. Game back on timeout. We have pricing. This helps obviously calculate your revenue and your ARR, but it also helps the venture capitalists understand what price points you think that your different products will have. Now, I wouldn't go too detailed. This is pretty high level. We've got a few product lines. That's it. I think a lot of very early stage startups that have no revenue get very complicated pricing models. You spend a lot of time mucking around in Excel. And you know what? If you haven't actually sold that to a client yet, then you're sort of wasting everybody's time. You're just goofing off in Excel. Instead, I say just sort of, we expect each customer to pay us X. It's really great for a seed stage company. Okay. Now, there's a little toggle here that I built just for the SaaS company. Sometimes SaaS businesses have non-ARR style revenue. This is just a toggle to drive your monthly recurring revenue, MRR and ARR calculation.
So would that be something like an onboarding cost or something like that? Or
Yeah,
what is a
this, right. So for this particular, for the 4 Ps, we said eventually part of their business model will be referral fees, and we're not going to count that as ARR. That's pretty normal, right? And sometimes some companies have implementation fees. Sometimes you have some services that are one-off services. You need to be pretty clear with the VC how you're describing your ARR. And a lot of VCs have different ways to talk about ARR. I kind of noticed this when I was first working with one of the best Sandhill Road VCs. This particular partner talked about ARR in terms of bookings because he was used to large enterprise sales, and so he wanted to know what you were closing, and then he wanted to know what you were actually billing. So the book to bill ratio, your recognized revenue, that was a key focus for him. Really fascinating. And so just keep in mind, VCs can think about this stuff a little bit differently, and you just need to have a consistent way that you're thinking about it. Again, back into the model. For this particular business, we're assuming that each dollar in revenue has a certain amount of cost associated with it. And see they kind of change a little bit. There should be a story here. See how this changes pretty aggressively over time? There should be a story. Okay, something like this there should be a reason why this is changing so much. Let's get to the headcount part, which I actually happen to love. Okay, so when projecting headcount, there are a couple of ways to do it. I think, though, that particularly when you're projecting far out into the future, it makes sense to bucket your employees into different types of employees, like maybe senior engineer, junior engineer, designers, customer service, marketing, sales, because right now maybe you have 5, 10, 20 people on staff, and sure, you could list out Mary and Jim and Amit and everybody, but then guess what happens when you're hiring people 4 months out who you haven't identified yet? You don't have a name, right? And in fact, does it make sense to have 100 rows for your new employees where you have new engineer 1, new engineer 2, new engineer 3? No, it doesn't. I suggest you bucket those people into like types of employees who have similar salaries, so that it's just very simple to say, hey, listen, I'm going to have, in this, May of 22, I'm going to have 11 engineering and product employees who are going to be making about 175K each. Simplify it that way, right? And in terms of the way this model works is you just put the number of folks you have at that position and the salary, and then it will calculate below their payroll, and it will add in benefits and things like that below.
I've got to say, the first time I saw this in your model, I was like, because I was definitely have like 300 rows for like future employees, especially if I'm trying to do projections. I think it's absurd to do 6-year projections. I know we slightly different opinions there, but the like trying to have a like 900 row 6-year projection. This is how much junior engineer 19 is going to get paid. It is completely bizarre. And so this is a way more elegant way of doing it. So thank you for introducing me to that.
This is a lot easier. And for the models that we build for our clients, we actually do what we call driver-based hiring. So not in the super near term, but out in the year 4 or 5, we just talk with the executive and understand, listen, how many sales folks will you need per new sale? Okay, well, we figure out how many sales we got and do some math, just some division. And that way, when you change your projections, the number of folks that you are hiring in the out years changes as well automatically. So that when you're doing assumption planning, you don't have to go and change everything out in year 5 manually every time. So it definitely speeds things up quite a bit.
Well, and the thing we haven't really talked about yet, which may be a little too granular for this particular talk, is scenario planning, right? What if, like, anybody who raised money in January of 2020 had a pandemic to deal with, which in one way or another, impacted every single business. If you have a good financial model and a pandemic hits and you go, oh crap, this is going to, like, I'm in entertainment and this is going to massively impact my business, having a really good model and be able to do easy scenario planning is gold dust. Or if your business suddenly takes off and you're like, oh, actually, we're growing 2x faster than I was hoping, not having to completely start from scratch, but instead using your existing model that you know and love and have become familiar with to do this kind of planning, especially if it multiplies out as you do here with, if we 3-double our marketing spend, maybe there isn't a linear growth trajectory. Maybe a smaller marketing team can handle the additional spend, but you do need some additional people, et cetera, et cetera. It is so valuable, and it can't be overstated how useful it is to work with Kruze or somebody like Kruze to build these kind of models that you can actually use for something useful.
So one of the most important scenarios you should at least think through, and you should have used your Excel to play with this, is if you're a pre-revenue company who is projecting to get revenue during the amount of time that your next round lasts for. So right, let's say you're going to close a round next month and you expect it to last for 18 months. You expect to generate substantial revenue in the outer months in the future before you run out of cash. Like, you should just zero out that revenue and see what it does to your cash position and your cash out date. Right.
Yeah.
That's a very common scenario that the VCs are going to look at. Like, hey, what happens if you haven't started generating revenue in the time frame here? Do you run out of cash really soon? So those are exercises to play with just to see what happens, to see how long you can last. And then, of course, the corollary of that is, hey, listen, if it's taking longer for a product to get out, perhaps we hire fewer engineers, reduce our burn. Now, of course, these things feed off of each other. It's entirely possible that you can't launch a product without those engineers, but just, that is the most basic level of scenario analysis that you should have. All right.
Love it.
Back on to the quickly walking through the projections here. This is highly simplified sales and marketing spend, R&D spend, rent spend. Some of these are based on like number of clients that you add. So this is the CAC for new clients added.
Yeah.
So some are just based on number of employees, right? Pretty simple. Again, I don't think you need to be incredibly complicated here. You're not trying to wow them with how you're renovating your office for a tiny bit of money or anything like that. That is just not particularly germane, I would say, to the discussion. We have some part of the model which is not particularly important, which is the fixed assets and depreciation. In fact, I don't really think this is useful at all for a SaaS business. Probably should have pulled it out. Now we get to the interesting part, which is your cash balance. Okay, so this is the beginning of period cash, end of period cash. Row 160 is showing where you're raising capital. Okay, so we're saying we're raising $9 million. You can see the cash position go up, and then you watch it go down as we burn. So again, the VC will kind of scroll out to figure out, where am I about to run out of money, right? So if you just delete out the fundraise, they would be able to say, hey, listen, I am running out of money in August of 2023. So therefore, in June or July, I should raise my next round.
Well, you should close your next round. So you should raise your next round in January.
The money should be in your bank account so that you can continue to pay your employees.
Apparently that's important. I don't know. I'm not a finance guy.
It is super important. Yes. All right. Yep. So at a high level, that's how the model runs. And where you're going to be spending your time talking through is your hiring assumptions, your revenue and pricing assumptions. Like, that's where you'll probably spend most of your meat. And then there'll probably be meat around the customer acquisition cost as well. Those are sort of the most important parts for SaaS companies these days. Of course, it will vary by industry. For marketplaces or, biotech obviously won't have any sort of customer acquisition cost, but just in general, for most of the businesses we work with, or many of the businesses, those are the key things where the VCs are going to want to start to focus.
Yeah. And I'll put a layer on top of this, is that this spreadsheet is going to be super helpful for you as an operator to run your business. And the things that are important to you are not necessarily the same things that are important to a VC. So be very clear on the kind of things, like understand how VC works, and be very clear on the kind of things that they care about. As you just mentioned, how little or much you spend about fitting out an office, nobody gives two craps about, unless it's outrageous.
Unless it's outrageous, yeah. In which case, you got a problem.
Sure. But then that becomes, so think about what is the kind of stuff that your board would like input into, right? If you're suggesting if you turn into Airbnb style spending $20 million on outfitting an office, the board will want to have a conversation with you. If it's not, so look at it through that lens. It's like, if you show up to a board meeting and you were to talk about any of this or not talk about any of this, would they appreciate or be upset by it? That is the type of information that needs to be talked about at the VC level when you're raising money.
Exactly. And so there's one other place that I think does matter to a founder, and that is your salary. This is a way to communicate your salary expectations after a fundraise. A lot of the founders we work with are paying themselves very little to nothing as they're seed funded, and then they raise an A and they want to get a more reasonable salary. This is one of the places you communicate that to the VC. And I'll definitely encourage people to make sure that you are getting a market clearing salary after you raise a fair amount of money.
Yeah.
If you go to Kruze's website, or you just search Kruze for our CEO salary report, we analyze CEO salary every year, just to ballpark where it is for seed, Series A, Series B. But make sure you're getting paid.
Yeah,
it's pretty important. All right, so let's. I think it's probably time to wrap this up. I think we've walked through it enough. Like, just let's summarize. Like, again, the model is part of your sales process, and it's telling your story. So everything you've talked about for your business strategy, needs to overlay in here, right? If you need salespeople to grow your business and you say that's how you're going to grow, you better have salespeople in here, right? If you say your average customer in 3 years is going to be paying you $3,000 a year, the model ought to be pointed in that direction, right? Like the VC is looking to confirm with the numbers in here that the strategy you've articulated is also the strategy that you're planning on executing.
Yep.
Okay. Make sure you're getting big enough in the out years. Make sure you know where you're going from a dollars and cents perspective, and just be like, this is your roadmap, right? So, spend time on this. It does matter.
Yep. And again, the overarching thing is know what your VCs need to know, and know that this backs your story.
Mm-hmm.
I think if you get those two right, then you're cooking on the gas, as we say in other places.
I don't know that people say that, but okay. Awesome. All right. Well, why don't we dive into some of the common mistakes that we've seen people make with the model? Okay.
Let's.
I'm just pausing for a second because Google signed me out. 1 second.
Thanks, Google.
Thank you. Good timing. All right. So let's talk about some of the common issues I've seen with financial projections. The first one that I've seen that is very frustrating is where companies getting strangely profitable. And a lot of times what this is that the CEO spent time doing revenue projections, but is not increasing their headcount, isn't increasing the marketing spend, isn't increasing the G&A. I mean, it's a fact of life. When you get to $50 million in ARR, you're going to have a lot of expenses, right? So, if you're going to be more profitable than Google, you ought to have a pretty compelling reason for that. Okay. So just look at your model and you're suddenly throwing off a bunch of cash. You probably didn't add enough expenses. Okay. The flip side is the other place that I've seen big issues is where CEOs try to be too conservative with their projections. And this is what's called modeling yourself out of a deal, where you're so conservative that an investor looks at your numbers and they're like, this isn't big enough. It's not interesting enough. It spends too much money. Don't be too conservative. You kill your deal there, right? You're dreaming big. Everybody understands in Silicon Valley that the idea is to grow really big.
Yep.
Well, the investor basically wants your company to return their entire fund if it succeeds. So the success that you're showing ought to be worth a lot of money if you're playing.
And there's actually worth digging a little bit deeper there, because remember, you are in this for a successful business, but your VC is actually, they've got a portfolio, right? They, out of every fund, they invest in 20 to 30 companies, depending on their model. And they just need one of them to be massively successful to return the fund, and two of them to be fun, like they're going to be drinking champagne the rest of the year.
Yeah.
That has to be reflected in these models, right? This is high risk investing also to the investors. They want to see high returns. And if there's a real risk that your company goes horribly wrong and fails, that's not actually the worst thing that could possibly happen. The worst thing that can happen is that they deploy a lot of money into your company. It takes you 15 years and they get a 1x return. They only get their money back. That means they've made a poor investment. And so tell the story here that this could be a fund returner.
Mm-hmm. Exactly.
It's a little counterintuitive, because that's
right.
where your alignment is a little bit in contrast with the VC's alignment, but you have to be able to tell both stories here.
Exactly. Now, again, there's another flip side to this, right? So now we're going to flip the coin back over to the other side.
We're just pancakes now.
Exactly. It doesn't make any sense, but I'm going to tell you, too much in revenue can be bad as well. And too much is, $1 billion in revenue in 3 to 5 years from a cold start. Like, that's a lot of revenue. You don't have to show that crazy of a revenue growth. I have not seen very many companies in my career that can do that. I have seen some that grow very, 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 very fast. And I'm working with one right now that's blowing my mind. But even there, I don't think you actually lose credibility when your numbers get too big. So this is where talking to your current investors, reading the room, and talking to other founders who are in similar situation a little bit ahead of you, understand what they're doing and model it off of those successful people. You're not too extreme here, too conservative, too crazy big, too crazy profitable. Like, when you get to the outliers, it actually starts to get weird. With, of course, the caveat again being that all investments in Silicon Valley are intended to get very big, kind of unrealistically, but they're even for Silicon Valley, there is a too unrealistic of revenue growth that it can make people kind of chuckle at you a little bit there.
And I think what we're talking about here is that you want realistic but aggressive. And then if you outperform on top of that, you're doing really, really, really well. So yeah, don't be shy, but also,
Yeah, exactly. So other places that companies can make mistake is not thinking a lot about the cost of goods sold or other direct costs of the business. Now, for many SaaS businesses, that's not that big of a deal, but there are some businesses in particular, as you're starting to get into hardware and whatnot, like you need to really think about that carefully. So as the business generates revenue, there's this cost line that just kind of goes up with it. Advice I give a lot of founders, particularly in the hardware space, that have a negative gross margin right now, so that means for every dollar they sell, they immediately lose a little bit of money, is to explain the path to you that flipping. And you have a business where for every dollar that you put out the door, you get 50 cents, 75 cents, 90 cents in actually profit that can then support your operations. Yeah. Right. So you should have that path to positive gross margin. Negative gross margin companies can get funded, particularly at the very small stage, but there's got to be a road to somewhere that is actually a more sustainable business.
Yeah. And I guess the other one is, remember that hiring gets more expensive as you grow. There's a reason why Facebook and Google famously pay really good wages. And that's because they need the best people they can get their hands on. But also there's a huge amount of opportunity cost for those people, right? Mm-hmm. Anybody who joins Facebook could also be joining a early stage startup, right? Where they get paid a lot less salary, but get a much higher potential upside in the form of equity. Now, exactly. That as your company grows and as you hand out less and less equity to your staff, which you should, because it doesn't make sense otherwise, remember, like, it gets a lot more expensive, because suddenly as you get big enough, Series B, Series C, beyond, now you're competing with Facebook on very similar terms. And so unless you have some sort of business that has like an ethical or moral thing that makes people go, oh, I really want to solve this problem, you're going to struggle to hire the right people after a while just on competitiveness.
Exactly. And another common mistake I see is forgetting payroll taxes or benefits. Mm-hmm. And particularly as you get bigger, those might get bigger. It's more important, though, in the near term for your operating numbers, so that you realize that for every person you hire, you're probably spending 30% more on their benefits and payroll taxes, right? Just don't forget about that, because you could run out of money a lot faster than you anticipate if your primary expense is headcount and it's 30% higher than you projected. So just don't forget about that. Yep. For some businesses, working capital matters, right? And this is the timing of when money goes in and out of the door. That's different than when you're recognizing revenue or expenses. So the easiest way to think about this is, if you're a direct-to-consumer business that has got to get inventory, you'll have to often write a check to get the inventory sent to your warehouse, or to have your third-party provider or logistics provider store it, right? And like that doesn't actually flow through your income statement. It's questionable how much detail you need at the super early stage in terms of where you're, like, from an accounting perspective, if you're recognizing all your expenses correctly. Like, I think people care less about that. It's more about the bottom line of the cash. So just think through the cash flow. Think through, if you're getting paid up front from customers, that actually helps your cash flow. Or if you're selling to large companies, it may take them 60, 90 plus days to pay you. That hurts your cash flow. So these are just minor items just to think through. You may or may not need them in your model, but you should at least have sat down and thought about them for a few minutes, right? So again,
and they become more important as you get closer to cash out date. If you have a $20 million buffer, who cares if you get paid in 30 or 60 days? If you are running out of cash, that starts becoming really important. And that's a really bad time to have to renegotiate with your customers, because they know they have you over a barrel at that point. So exactly. Be very careful about, again, just echoing what you're saying, but be very careful to think about that in advance.
Exactly. So we've already talked about it, but a big mistake is being too detailed. You're trying to talk to investors. You don't want them to get too far into the weeds. So pick the level of detail that's appropriate. And then finally, for seed and Series A companies, sometimes I see founders spending too much time on the projections and not enough time on other things that can benefit their pitch and their process. I wouldn't, like, if you're really comfortable in Excel and you find you're spending a lot of time in it, you're probably spending too much time in Excel. Right? Like, don't go and do the thing you like because it's the thing you like. Do the things you need to do to get your business moving.
Yep, absolutely.
Perfect.
Haley, I have a confession to make. I actually enjoyed this episode a lot more than I thought I would.
Okay, good. Thank you. Well, I will. I think that's a compliment, right?
I think it's a compliment.
Wonderful.
Yeah.
All right. Well, everyone, we will be releasing this Excel file on our website, kruzeconsulting.com/pitch-deck. Additionally, we'll have the free template for the 4 Ps, the pitch deck that we showed. And then we have a consumer business that we made up as well, that we have the pitch deck there. You can follow along the whole course. We hope that you enjoyed this. And Haya, thank you so much.
Lovely to be here.